I am Deepha from the Department of MBA in SNS College. Today we are going to discuss about tax. First, we should know what is the meaning of tax. A tax is a mandatory fee or financial charge levied by any government of an individual or an organization to collect revenue of public works providing the best facilities and infrastructure. The collected fund is then used to fund different public expenditure programs. If one fails to pay the tax or refuses to contribute towards it, will invite serious implication under the predefined law. Next, we are going to discuss about the types of tax, direct tax and indirect tax. First, we see what is a direct tax. You are paying the tax directly. Indirect tax, you are paying the tax indirectly like GST, like that. Example, if you're going to the hotel, you're going to pay the amount there, including that rupees 0.50, that is a GST. So now we are going to see about the types of direct tax. First, Income Tax Act. The Income Tax Act is also called as the IT Act 1961. It was introduced in the year 1961. The income tax by this act owing a property of a house, business, etc. The IT Act also defines the tax benefit you can avail of one of the life insurance premium or fixed deposit. It also decides the saving from your income via investment and the tax slab for your income tax. Next is Securities Transaction Tax, that is STT, is a tax levied on the purchase and sales of securities such as stock, mutual funds, and diversifications on recognition stock exchange in India. The STT rate varies depending on the type of security being traded. For example, the STT rate for equity shares is 0.1%, while the STT rate for further contract is 0.005%. Next, capital gain tax. Capital gain tax is a tax on profit earned from the sale of assets such as stock, bonds, real estate, or other investment. The CGD, that is a capital gain tax rate in India, depends on the holding period of the asset and the type of the asset being sold. For example, short-term capital gain on equity shares are taxes 15%, while long-term capital gains on equity shares are exemption from taxation. Next, indirect tax. The tax levied on goods and services are referred to as indirect tax. They are different from direct tax as they are not imposed of an individual who sells them directly. On Indian government. They are as an alternative imposed on the product and an intermediary. The individuals selling the product collect them. The most common example of the indirect tax are sales tax, tax levied on imported goods, value-added tax, etc. Such tax are imposed by submitting them the price of the product or service that is likely to push the price of the product up. Types of indirect tax, you have the sales tax, service tax. Under sales tax is a consumption tax levied on the sale of goods and services. It is typically a percentage of the retail price of item being purchased. Sales tax is collected by the seller and then remitted to the government. Service tax. Service tax is purchased on the rate of 15% and it is applicable to service provided by companies. Individual service provided pay when the bills are settled, while firms pay upon invoicing regardless of bill payment. Restaurants charge service tax 40% of the total bill on to avoid ambiguity. Next, goods and service tax. Under goods and service tax, it is levied on the goods and services at each stage of the supply chain. Value added tax is imposed to all the supply chain stages, excluding the zero rated items like food and essential drugs. Customs duties on the ordered, it is the imported goods that ensuring the taxation on products entering the country. Excise duty, or also called as a central value added tax, it is imposed on the manufacturing goods in India. Then you have the advantages of direct and disadvantages of indirect tax. So disadvantages of direct tax, complex calculation of recording keeping, high rate may discourage investment. In indirect tax, this places a higher burden on low income household, difficulty in understanding the actual tax amount. Thank you.